Hello and welcome to the Financial Times here in New York. Janet Yellen's chairing of her first policy meeting and press conference presented investors with a reminder that all good things must end, and perhaps sooner than what many in the bond market had been expecting up until this week. It was accomplished by the upgrading of rate hike expectations by Fed officials, with more of them now forecasting the federal funds rate will be at least 1% by the end of 2015. This is up from a prior estimate of 0.75%. Fed officials now expect rates to reach 2.25% at the end of 2016. Then during her press conference, the Fed chairwoman said that while the Fed could start raising rates towards the end of next year, under another scenario, it could start by mid-2015. With the Fed still purchasing $55 billion of Treasury and mortgage bonds each month, policy remains very accommodative. But should the economy gather pace during the spring, bond yields, which move inversely to prices, are likely to turn substantially higher. That was highlighted on Wednesday as the bond bears wasted little time pushing the yield on two-year Treasury notes, the most monetary policy sensitive benchmark, sharply higher and to a level we haven't seen since last September. It also comes when exchange-traded funds that track short-dated Treasuries are currently posting the largest industry outflows during March. Much, however, depends on the economy and whether it bounces back strongly from a harsh winter. It may well be that the bond market is simply getting worked up for nothing, and that sharply higher Treasury yields, like we saw at the start of this year, beckons as a buying opportunity for investors.